This isn't speculation. It's the documented pattern from every major debt cycle crisis in recorded history. The Roman Empire debased its currency when military costs became unsustainable. Weimar Germany printed money when war reparations exceeded economic capacity. Britain chose inflation over default after World War II. The pattern never changes because the political incentives never change. What makes our situation unique is the scale. Never before has the world's reserve currency issuer reached this level of indebtedness. When previous empires faced debt crises, the global economy could continue functioning because other currencies remained stable. But when the dollar faces a crisis, there's no alternative system large enough to absorb the shock. This creates what I call the reserve currency trap. The United States has been able to run massive deficits for decades because the world needs dollars for international trade. This exorbitant privilege allowed America to export its inflation and import real goods and services. But that privilege isn't permanent. It's a function of economic and military dominance, and both are being challenged simultaneously. The signs of dollar hegemony erosion are becoming undeniable. China and Russia have dramatically increased bilateral trade in their own currencies. Central banks globally are reducing dollar reserves and increasing gold holdings at rates not seen since the 1970s. The BRICS nations are developing alternative payment systems. Even European allies are creating mechanisms to reduce dependence on dollar transactions. This matters because when a reserve currency loses credibility, the transition happens much faster than anyone expects. The British pound dominated global finance for over a century. But its displacement happened primarily in the 2 decades after World War II. The process accelerated once it became clear that Britain could no longer maintain its economic dominance. We're seeing early signs of the same process today. The dollar's share of global reserves has declined from 72% in 2000 to 58% today. More importantly, countries are actively building infrastructure to bypass the dollar system. When that infrastructure becomes operational, which is happening now, the transition can accelerate rapidly. Now let me explain why this matters to you personally and what you can do about it. When reserve currency transitions occur, they create massive wealth redistribution between different types of assets. Those who understand the transition and position appropriately preserve and often multiply their wealth. Those who don't understand find their wealth quietly confiscated through currency debasement. The 1970s provide the perfect case study because it was the last time the United States faced a currency credibility crisis. When Nixon closed the gold window in 1971, he ended the Bretton Woods system and created the modern fiat currency regime. The consequences played out over the following decade in ways that most people still don't understand. Let me tell you about 2 families I researched from that period, the Johnsons and the Millers. Both were middle-class families living in suburban Chicago in 1970. Both had saved $75,000, which was substantial money at the time, enough to buy 3 nice houses. The Johnsons kept their wealth in traditional safe investments, savings accounts paying 5% annual interest, certificates of deposit, and government bonds. It seemed like the prudent choice. After all, they were earning a decent return with no risk, and conventional wisdom said savings accounts were the safest place for money. The Millers made a different choice. Influenced by a relative who understood economics, they diversified into what economists call real assets, stocks of companies with pricing power, real estate, commodities, and a small allocation to gold. It seemed riskier because these assets fluctuated in value, unlike the steady returns on savings accounts. Fast forward to 1980, the Johnson family's savings account had grown to $122,000, an increase of 63% over the decade. They felt vindicated. They had earned steady returns with no stress, no volatility, no risk. But here's what they didn't understand. Cumulative inflation during the 1970s was 112%. Their $122,000 in 1980 could buy less than half of what their original $75,000 could buy in 1970. The Johnsons had worked for 10 years, lived below their means, saved religiously, and followed every rule of conventional financial wisdom. They became substantially poorer. Their purchasing power was systematically confiscated through the invisible tax of inflation. The Miller family told a different story. Their diversified portfolio of real assets grew to $285,000 by 1980. They not only preserved their purchasing power, but nearly doubled their real wealth. The difference wasn't luck or superior intelligence. The difference was understanding that during periods of currency debasement, wealth transfers from financial assets to real assets. If you understand how money actually works, you understand that we're reliving through the final chapter of a monetary experiment that began in 1971. What most people call the economy is actually a machine, and that machine is now making sounds it hasn't made since the 1930s. I've spent the last 30 years studying economic cycles, monetary history, and wealth preservation during major transitions. What I'm about to tell you will fundamentally change how you think about money, investing, and protecting your family's financial future. We're not just facing another recession or bear market. We're approaching the end of the longest debt cycle in American history. And when these cycles end, they don't end quietly. They end with massive wealth redistribution from those who don't understand what's happening to those who do. The last time this occurred was between 1929 and 1945. Before that, the 1870s. These transitions happen roughly every 75 to 100 years, and they reshape entire civilizations. The machine I'm talking about runs on three forces: productivity growth, short-term debt cycles, and long-term debt cycles. Most people only see the surface, the daily market movements, the quarterly earnings reports, the monthly employment numbers. But underneath, these three forces are grinding toward a convergence that will determine your financial fate for the next 20 years. Let me start with productivity growth because it's the foundation of all real wealth. Productivity is simple. Are we producing more value per person this year than last year? Are we more efficient? Are we innovating? When productivity grows consistently, living standards rise. When it stagnates, everything else becomes a zero-sum game where wealth gets redistributed rather than created. Since 2000, American productivity growth has averaged just 1.2% annually, compared to 2.8% from 1947 to 1975. This slowdown isn't temporary. It reflects fundamental challenges: an aging workforce, declining infrastructure investment, and the diminishing returns of past innovations. When productivity growth slows, the economy becomes increasingly dependent on debt to maintain growth and living standards. This brings us to short-term debt cycles, which most people recognize as business cycles. Every 5 to 8 years, the economy expands as people borrow and spend, then contracts when debt levels become unsustainable. Central banks respond by lowering interest rates to restart borrowing. This pattern has repeated consistently for over a century. But there's a third cycle operating underneath that most people never see: the long-term debt cycle. Ovvedikad dermule cross sevrevdimi. Government debt, corporate debt, household debt, all building up year after year. Eventually, you reach a point where the total debt load becomes mathematically unsustainable. You can't service it with current income. You can't grow your way out of it because productivity growth is too slow. And you can't refinance it at lower rates because rates are already near zero. That's exactly where we are today. Total debt in the United States government, corporate, and consumer combined now exceeds 350% of GDP. Government debt alone is $34 trillion, representing 127% of economic output. The federal government spends over $1.1 trillion annually just on interest payments, more than it spends on defense for the first time in modern history. These numbers aren't just statistics. They represent the mathematical endpoint of a system that has been borrowing against the future for 5 decades. When interest payments exceed productive government spending, you've crossed a line that no major economy has ever crossed without fundamental restructuring. The restructuring comes in one of 3 forms, and understanding which form is most likely determines whether you preserve your wealth or lose it. Option 1 is fiscal austerity: dramatically cut spending and raise taxes to actually pay down the debt. Option 2 is outright default: simply declare bankruptcy and refuse to pay. Option 3 is monetary debasement: create enough new money to pay the debt in devalued currency. History shows us that governments always choose option 3 because it's politically easiest. They can't get re-elected promising to cut Social Security or eliminate Medicare. They can't survive politically by declaring bankruptcy. But they can gradually transfer wealth from savers to debtors through the invisible mechanism of monetary inflation. This wealth transfer mechanism operates through what economists call the Cantillon effect, named after 18th century economist Richard Cantillon. When new money is created, it doesn't appear equally in everyone's bank account. It enters the system through specific channels: banks, financial markets, and large institutions first. Those close to the money creation process can use this new liquidity to buy assets before prices rise. Those far from the process, wage earners and small savers, only feel the price increases after the wealth transfer is largely complete. During the 1970s, this process was clearly visible. Asset prices rose faster than wages. Real estate values exploded. Stock prices of companies with pricing power multiplied. Gold went from $35 per ounce to $850, a 24-fold increase. But wages barely kept pace with inflation, and savings accounts earned negative real returns throughout the decade. The same process is happening today, but on a much larger scale. Since 2008, the Federal Reserve has created more money than in the entire previous history of the United States. Asset prices have responded predictably. Stock markets have reached levels that seemed impossible just a few years ago. Real estate prices have increased so rapidly that entire generations have been priced out of homeownership. Even collectibles and luxury goods have seen extraordinary price appreciation, but we're still in the early stages of this wealth transfer. The money creation that began during the 2008 crisis has accelerated dramatically. Between 2020 and 2022 alone, the money supply increased by over 25%. This newly created money is working its way through the system, bidding up asset prices while gradually eroding the purchasing power of saved dollars. Most Americans don't understand this process because they've been taught to think about money in nominal terms rather than real terms. They see their savings account balance remain steady and feel secure. They don't realize that steady nominal value represents declining real value when the currency is being systematically debased. This misunderstanding is about to become extremely expensive. Based on current debt dynamics and political incentives, monetary debasement will not only continue but accelerate. The $34 trillion national debt continues growing by over $2 trillion annually. Interest payments are consuming an ever larger share of government revenue. The political impossibility of meaningful spending cuts or tax increases leaves money creation as the only viable option. Understanding this dynamic allows you to position yourself on the winning side of the wealth transfer rather than being its victim. Throughout history, certain types of assets have consistently preserved value during periods of currency debasement, while others have been systematically destroyed. The assets that preserve value share three characteristics. They maintain utility regardless of currency value. They have pricing power during inflationary periods. And they represent claims on real economic resources rather than promises to pay in depreciating currency. Let me walk you through the four categories of assets that have historically preserved wealth during major monetary transitions, explaining not just what they are, but why they work, and how to think about allocating between them. The first category is businesses with genuine pricing power. Not just any businesses, but specifically companies that can raise prices faster than their costs increase during inflationary periods. These businesses share several characteristics. They produce essential goods or services that people need regardless of price. They have strong brand loyalty or monopolistic positions that prevent customers from switching. They generate substantial cash flows that can be distributed to owners, and they own hard assets that maintain value independent of currency. During the 1970s, while most stocks went nowhere for a decade, certain companies multiplied their shareholders' wealth. Energy companies that owned oil and gas reserves saw revenues explode when oil prices rose from $10 to $80 per barrel. Their costs increased much more slowly than their revenues creating massive profit expansion. Agricultural companies that owned farmland benefited from rising food prices. Utilities with regulated rate structures passed increased costs through to consumers while maintaining guaranteed margins. Consumer staples companies like Procter & Gamble, Johnson & Johnson, and Coca-Cola demonstrated the ultimate pricing power. When their raw material costs increased, they simply raised prices. Consumers complained, but continued buying because brand loyalty was strong and the products were essential. These companies' stock prices reflected their ability to maintain margins during inflationary periods. The key insight is that these weren't speculative growth plays. They were wealth preservation vehicles. When currency is being debased, you want to own pieces of businesses that can debase along with the currency while maintaining real value. A company that can raise prices at the same rate as currency debasement protects your purchasing power. A company that can raise prices faster than currency debasement increases your real wealth. The fourth category is productive real assets that generate income regardless of currency value. Agricultural land, rental real estate, infrastructure assets, and natural resource properties all share the characteristic of producing something people need, independent of financial market conditions. During the 1930s depression, when financial assets collapsed, farmland values held relatively stable because farmland produces food and people need to eat regardless of economic conditions. During the 1970s inflation, agricultural land doubled and tripled in value as food prices rose. Real estate generated rental income that increased with inflation, protecting owners from currency debasement. The key insight is that real assets produce real things. A farm produces crops, a rental property provides shelter, an oil well produces energy. These productive capacities don't disappear when currencies are devalued or financial markets crash. In fact, they often become more valuable because the things they produce become relatively scarcer as financial assets lose value. For most people, direct ownership of farmland or commercial real estate isn't practical due to capital requirements and management complexity. Real estate investment trusts REITs provide exposure to productive real assets through publicly traded securities. The best REITs own high-quality properties in essential sectors: residential housing, healthcare facilities, data centers, agricultural land, and industrial properties. Quality REITs share several characteristics. They own properties in locations with limited supply and strong demand. They have experienced management teams with long track records. They maintain conservative debt levels and strong balance sheets, and they have histories of increasing dividends over time, demonstrating their ability to pass inflation through to tenants. Addito 15%. Allocation to productive real assets rounds out a portfolio designed to preserve wealth during major monetary transitions. These assets provide current income, potential appreciation, and most importantly, exposure to real economic activity that continues regardless of financial market conditions. Now let me explain how to integrate these four categories into a coherent wealth preservation strategy. The key is understanding that this isn't about maximizing returns during normal times. This is about surviving and thriving during the transition from one monetary regime to another. The allocation I recommend based on historical analysis is 35 to 40% in businesses with pricing power 10 to 15%. In physical precious metals 20 to 25% in short term. Treasury, securities and cash and 10 to 15% in productive real assets. The remaining 10 to 30% can be allocated to higher risk, higher return opportunities based on your age, expertise, and risk tolerance. This allocation provides several advantages. It's diversified across different types of real value, not just different financial instruments. Each category responds differently to various economic scenarios, providing stability regardless of whether we experience inflation, deflation, recession, or stagflation. The allocation maintains enough liquidity to take advantage of opportunities, while providing enough defensive positioning to survive extended, difficult periods. Most importantly, this allocation protects against the specific risk that most Americans do not recognize, the risk that the monetary system itself changes fundamentally during their investment lifetime. Traditional portfolio advice assumes currency stability. It assumes that the monetary rules that worked for the last 40 years will continue working for the next 40 years. History suggests this assumption is dangerous when debt levels reach unsustainable levels. The implementation of this strategy requires discipline and patience. You can't reposition overnight without creating unnecessary risks and transaction costs. The systematic approach is to gradually move from vulnerable positions to defensive positions over a period of 6 to 12 months. Start by identifying your most vulnerable positions, long-term bonds, growth stocks with no earnings, speculative investments, and excessive concentration in any single asset class. Begin reducing these positions systematically, perhaps 10 to 15% per month. This allows you to average your exit prices and avoid trying to time the perfect moment to sell. Simultaneously, begin building your defensive positions. Month 1. Make your first purchases of physical precious metals and high-quality businesses with pricing power. Month 2. Move cash to short-term Treasury positions and add more defensive equity positions. Month 3. Continue building all four categories while reducing vulnerable positions. Continue this process until you reach your target allocation. The psychological challenge is enormous because this repositioning often occurs while markets are still rising and traditional strategies are still working. Your friends may be bragging about returns from growth stocks or cryptocurrency. Financial media may be celebrating new market highs. Your current advisor may be telling you that you're being too conservative. Ignore all of this noise. You're not repositioning based on next quarter's performance. You repositioning based on where we are in a 75-year debt cycle and what that means for the next 10 to 20 years. Short-term performance is irrelevant. Long-term survival is everything. The biggest mistake people make is waiting for confirmation that they're right before taking action. By the time the transition becomes obvious to everyone, the major repositioning has already occurred. Asset prices have already adjusted to reflect the new reality. The opportunity to position defensively at reasonable prices has passed. This is exactly what happened during previous major transitions. In 1971, when Nixon closed the gold window, most people didn't understand the implications. Gold was still $35 per ounce. Oil was still $10 per barrel. Real estate was still affordable. Those who understood the significance of ending dollar convertibility to gold had nearly a decade to reposition before the effects became obvious to everyone. By 1979, when inflation was running at double digits and everyone understood that currency was being debased, gold had already risen to $500 per ounce. Oil was approaching $80 per barrel. Real estate had doubled in most markets. The repositioning opportunity was largely over. We're in a similar early stage today. The debt mathematics are clear to anyone who studies them seriously. The political incentives that make currency debasement inevitable are obvious. The international challenges to dollar dominance are accelerating. But most people aren't paying attention because the crisis hasn't yet reached the acute phase where everyone panics simultaneously. This creates a window of opportunity for those who understand cycles and are willing to act on that understanding. The window won't remain open indefinitely. At some point, probably within the next 18 to 36 months, the acute phase will begin. When it does, asset prices will adjust rapidly to reflect the new reality. Those who have already repositioned will be protected. Those who wait until the crisis becomes obvious to everyone will find that protection is no longer available at reasonable prices. Gold might be $8,000 per ounce. Quality businesses with pricing power might trade at extreme premiums. Real estate might be unaffordable for average families. Cash might be earning negative real returns as inflation accelerates. The choice is straightforward. Reposition now while defensive assets are still reasonably priced, or wait until everyone understands what is happening. And pay premium prices for protection that should have been purchased earlier. Let me be clear about what I'm not saying. I'm not predicting that the financial system will collapse tomorrow. I'm not suggesting that you should panic or make dramatic changes overnight. I'm not claiming that I can time exactly when the acute phase of this transition will begin. What I am saying is that the mathematical trajectory is clear, the historical precedents are documented, and the political incentives make certain outcomes highly probable. When governments face unsustainable debt loads, they choose currency debasement over default or austerity because it's politically easier. This creates wealth redistribution from holders of financial assets to owners of real assets. Understanding this pattern and positioning appropriately isn't speculation. It's preparation based on documented historical precedent. Every previous generation that faced similar circumstances had to make similar choices. Those who understood the dynamics and prepared accordingly preserved their wealth and often prospered. Those who maintained faith in the existing system and waited for others to tell them what to do lost much of what they had worked to accumulate. The mathematics are forcing a choice. The only question is whether you'll make that choice consciously and proactively, or whether it will be made for you by circumstances beyond your control. History suggests that conscious preparation produces better outcomes than hoping that somehow this time will be different. This isn't about fear or pessimism. It's about understanding cycles, recognizing patterns, and positioning appropriately for what comes next. Every major transition in history has created enormous opportunities for those who understood what was happening and positioned themselves correctly. The coming transition will be no different. The four categories of assets I've described have preserved and often multiplied wealth through every major monetary transition in recorded history. They work because they represent real value that exists independent of political promises or financial market conditions. When paper assets lose value due to currency debasement, real assets maintain their utility and often become more valuable in nominal terms. Your task is simple. Gradually reposition your wealth from assets that depend on currency stability to assets that maintain value regardless of currency performance. Do this systematically over the next 6 to 12 months. Ignore short-term market noise and focus on long-term positioning. Most importantly, act while defensive positioning is still available at reasonable prices. The window for intelligent repositioning is open now, but it won't remain open indefinitely. History teaches that those who wait for perfect certainty before taking action usually discover that certainty comes at a price they can no longer afford to pay. The choice, as always, is yours. But the consequences of that choice will determine your family's financial future for the next decades. Time is the most valuable asset in any major transition. Those who use time wisely to reposition gradually and thoughtfully preserve their options and their wealth. Those who waste time hoping that fundamental problems will resolve themselves without affecting them personally typically discover too late that hope isn't a strategy. The transition is underway. The only question is whether you'll be prepared when it accelerates.